311,000 jobs created in February, topping estimates of 225,000. The unemployment rate rising slightly to 3.6%, as did the labor force participation rate to 62.5. That's its highest level since March of 2020. And some good news for the Fed, and that average hourly earnings increased just 0.2% month to month. That is below expectations. Leisure and hospitality continuing to lead the way with gains of 105,000 jobs. What did we learn today? Let's hear from our panel, the Conference Board Chief Economist Dana Peterson and Invesco Global Market Strategist Brian Levitt. Nice to see you both. Dana, you are here in studio, so we will start with you and your one biggest takeaway from this morning's report.
The biggest takeaway is the fact that wages, average hourly wages on a year-on-year basis, ticked upward. That's really not good news for the Fed, because when we ask CEOs, what are you doing about rising labor costs, they're passing them directly to the consumer, and it's showing up in consumer inflation.
Brian, what about you? What was the one thing that really stuck out to you in today's report?
I was happy to see the labor force participation rate go up and back to early COVID days, which is a really good sign. People coming back into the workforce. The month change on wages was modest as well. So, given what's going on in the banking system, nobody would want to use the word Goldilocks today. But it was a good report in that the job creation remained strong, but the unemployment rate ticked up a bit and wages slowed. So all else being equal, not a terrible report.
And Dana, perhaps most importantly, how do you think Jerome Powell read this report?
Well, I think he'd be pleased and disappointed. So where he'd be pleased is the fact that we are seeing those pandemic darling industries such as transportation, warehousing, tech, manufacturing cooling off. And that's a function of the Fed's rising interest rates and also a shift in consumer spending away from mainly goods towards services. Where the Fed would probably be disappointed is the fact that you still have all this hiring going on, and it's mainly in those industries that are suffering from severe labor shortages like leisure and hospitality and also healthcare and social services.
So Brian, like Dana was saying, there's still lots of hiring clearly that's going on right now. So what do you think this means for the Fed's next move, and not just only its next move, but maybe its next couple of moves?
I have to think the Fed's getting closer to the end of this. I mean, the challenge that they've had in all of this is that when you raise rates the way they have over such a short period of time, things tend to break. And I understand that inflation is still well above their comfort zone. Directionally, we're seeing improvements. We've seen improvements in commodities and goods, stickiness in services. But the reality is they've raised rates so much. There's a lagged effect of it. We haven't seen what the implications of those lagged effects, and perhaps today we're starting to. And I believe that we're getting closer to the end. Once you start to have banking challenges, or dare we even say a banking crisis, the only thing that stops it is the end of tightening or policy support.
Yeah, the banking, the run on the bank that we saw today, any impact on the broader economy? And the market did move today to price in a 25-point hike. It was at a 50 just 24 hours ago. Do you believe this moves the Fed to a 25-point hike?
Well, I mean, unfortunately, banks do go under sometimes. And the thing is that, does this become systemic? If it can remain contained, then the Fed can continue to focus on inflation. But if it does become something where it feeds into the real economy and potentially causes a crisis and a recession, well, then the Fed might pull back. But I think for now, the Fed is very much focused on inflation. We're going to get another inflation report next week, as well as retail sales, to see how consumers are spending and if they're continuing to spend as much as they have been.
Dana, what is your read on the consumer? Because we heard from a number of the larger retailer players out there that they were seeing a pullback. A lot of consumers were trading down in many instances to some of those private label brands. Is that an indication that maybe the consumer isn't as strong as some of those headline numbers do indicate?
I think so. And when we look at our own consumer confidence index and we ask them, what are you planning on buying? They said, we're not looking to buy big ticket items or durable goods like cars. We're not going to look to buy homes or furniture to go into the homes. But the interesting thing is that they said they're also not looking to go on vacation. And we know vacationing and experiential services have been really hot. And so we're seeing some cooling in intentions, and we're expecting that to show up in the consumer spending.
Okay, so Brian, the data we'll get next week, a couple more reads on inflation. Do you expect the Fed will get the news they need, and do you believe a 25-point hike is their rationale at this point?
25 basis point hike is the rationale. I never fully believed that we were going 50 basis points. Will they get the data they need? We'll see. I mean, anything can happen month over month, but directionally, we're moving in the right way. And to Dana's point, even the services that consumers have been spending on, that should start to moderate here. So whether or not they get it in March, we know it's coming. And I know the Fed always says that they're data dependent. I wish that they would be focusing on things that were more leading. I mean, money supply growth has simply collapsed. Business inventories are up. To me, it's time to stop raising interest rates and assess the damage that has been done from all of these rate hikes. But, again, 25 basis points on Tuesday, or 25 basis points at the next meeting is likely in the offing.
Dana, do you sense it's time for a pause?
Well, we think there are probably a few more rate hikes. We have priced in March, May, and June. We had 25 basis point increases each, but certainly whatever happens next week, I think is going to be really important in terms of whether the Fed really does go 50 basis points. But I have to agree that we are probably getting close to the end, and there are only a few more hikes priced in.
All right, all eyes will be on that upcoming data next week. Dana, thanks so much for coming in here in studio. And Brian Levitt, always great to see you. Thanks. Have a good weekend.